Hello and welcome to the market report from IG Markets, the 2nd of July 2012. We've got off the week on a bad note, or so to speak. Risk assets seem to be coming under a little bit of modest bit of selling pressure coming through. Euro dollar, for example, is down about 30 pips. We've got the Aussie down about 10 pips or so. US futures opened up with a bit of a bang. They pushed up 15, 20 points or so on Dow futures, and now they're down about the same amount as well. So we've seen a little bit of a risk reversal, but I think we're starting to see some sort of funds looking to fade this move. I think Friday was really about positioning for me. We'd seen the market very, very short on euros, short on Australian dollars, short in equities, and we generally had seen quite a bit of closing out of those positions. Hence, we saw a giant move up. Clearly, Spain seems to have come out of the summit the winner. They've obviously got a nice boost by winning the European Cup at the moment, and if they need any kind of boost for sentiment, that will certainly help them with their unemployment rate at 20%, youth unemployment at 50%. These are the sort of things we need. They came into the EU summit looking for a number of caveats. They got pretty much most of them. An ability to try and bring down yields. We've got that through the use of ESM now to come actually and buy back bonds in the secondary market to directly infiltrate the banks and effectively cut out that negative feedback loop between weak sovereigns and banks. That's a very big positive there. So there's a number of good situations which came out of the summit, and markets have rejoiced that. Huge move up in euro dollar, huge move up in Aussie dollar, huge move down in sovereign spreads. We saw the Spanish 10-year, 2-year yield down 114 basis points. That's a massive move. Hence why the IBEX was up 5.6, 5.7% with financials up 7%. But clearly everyone's looking at that at the moment. There's still a lot of questions about the infiltration of some sort of supervisory body in Europe as well. Does the fiscal compact, how does that work out longer term? Is it going to have harsher austerity measures as a consequence of this? How did Germany stack up? There's been a lot of negative press over the weekend about Angela Merkel and the fact she's had to concede so much. But clearly what we're seeing at the moment is Asian markets have got off to a start where they're just questioning moves now. Where's the growth going to come from this? A lot of the measures we've seen are very much about addressing the implication or the symptoms of deficit situations where yields have been spiking up. We're going to see hopefully an alleviation of those in the short term, which allows risk to come on the table. We look at Asian markets today, they're generally up because they're taking into consideration the leads we got from Wall Street. 2.5% was a very, very positive session. But we are starting to get a few people, as I say, question these coming through. Now, this week is going to be a massive week. I think really on the S&P, we want to see a break above 1363. That's the 61.8% retracement of the year's high to low, also corresponding with the previous high as well. So that's a level we need to close above in the short term for other risk assets to move up and try and test those recent highs as well. So that's something we need to look out for. There's going to be a number of central bank meetings, not to mention just the one in Australia tomorrow, where pretty much every analyst that is surveyed by Bloomberg, I think there was 28, are still calling for the RBA to keep rates on hold. The swaps market still pricing in a 12% probability that we're going to get a 25 basis point cut. I think that's optimistic. I think that will come out and be priced out. It gives a touch of upside to the Australian dollar. We've also got central bank meetings this week from the UK, from the Bank of England, should I say, and also from the ECB. Now, they're both going to be very interesting. There's only one investment bank at the moment calling for rates to be cut in England. I think more importantly is about what's going to happen on their asset purchase program. It seems consensus now that we're going to get an extra 50 billion added to that asset purchase program. Some, I think 8 out of 50 odd surveyed were calling for 75 billion to be added to the Bank of England's asset purchase program. My personal opinion is if we do see a 75 billion or a 50 billion program, whilst in the long term that effectively is negative for sterling, I think the risk on rally will continue, and I think that will push sterling up at the same time. The ECB as well, most people are expecting now a 25 or a slight cut by the ECB. It's not fully priced into the swaps market at the moment, so that for me suggests quite an interesting trade where you could be short Euro Aussie on the premise of what happens on the interest rate side of things. Also, non-farms towards the back end of the week in the US will be very, very interesting. 90,000 is the headline number now that the market is expecting. The range is somewhere between 165 and 35,000 jobs, so quite a wide spread as we're always accustomed to. Clearly, if we get a very, very weak number there, that should be good for gold because it should feed into the idea that the Fed are more likely to print money further down the line. But an interesting week. It seems we're up to a bit of a topsy-turvy start at the moment. No one really sort of understanding where we're going to go. It's about fighting for positioning at the moment.